All right, this is Jeffrey Scott, and it is August 4th, and welcome to my webinar. For those of you who are new to these webinars, I go through a short PowerPoint presentation. I look at the market. I look at what I think are the best industries and sectors, and then we try and identify a couple of stocks to look at, and then I also do some bottoms-up approach with a couple of the shortcuts in the program. I am an independent. By training, I'm a cancer doc, but I do these programs on a weekly basis and enjoy doing them. So today I title it Complacency, QE Infinity, and Nosebleed Territory. I would say complacency is what the VIX is doing. As we'll demonstrate, the VIX is at where it likes to, doesn't like to fall much below, let's put it that way, which might be bearish. QE Infinity, which is what the Fed is doing, terminology from Gil Morales, Chris Cachua of the pocket pivot fame, and then nosebleed territory is when markets are extended. And I think we can say this market fits those. There's my email address, today's date. This is for educational purposes only. Anything I recommend in the spirit of education, not investment advice. I'm a doctor, not a broker. And I am an independent. I pay for the software and data I use. And I'm not demonstrating a single tool, but multiple tools that I find useful in the market. I rely on a lot of different tools. I've done this slide 1,000 times, so I'll just put it there. You can look at it. Stop it if you don't know what this is, and let's move forward. One of the most important things I learned from Ian Woodward here on the left is when he said, Jeffrey, he's not a guru. I'm not a guru from him. I'll teach you to be your own guru. You got to be your own guru. You can't rely on people whose videos you watch once a week or every night. And you have to build your style from being exposed to people that you respect. And for me, it's been Ian and Ron, Woodward and Brown Investing. It's been William O'Neill, Rouse and Katcher, the O'Neill Disciples, their second book, Trading the Cockpit, also excellent. Alexander Elder, books, webinars, live meetings. Van Tharp, position sizing and money management. Bigelow and Candlesticks. Gronke, money management. Willane in institutional volume. I have to know where stock falls. I won't spend much time on this slide, except we continue to pretend to roll over and then we take off again. And until that changes, one still has to be looking forward as a long, but as I'll show you, we are long in the tooth. Don't fight the trend. In an uptrend, you buy pullbacks. Pretty much doesn't matter where you buy as long as you're not the last person buying. In a downtrend, you sell or short retracements. In a sideways market, you buy support, you sell resistance, and you look for breakouts and breakdowns. A couple comments about the website. HighGrowthStock.com is an outstanding program. It's what I base the majority of my analysis on. HighGrowthStock.com is the website. This is before I log in, so free 30-day trial, including data. If you want to learn stuff, you can go under support. Actually, investing strategies under Ian Woodward. He has a weekly blog, which is outstanding. Under Ron Brown, he does frequent movies that are more educational on how to use HGSI, Thinkorswim, and other platforms, a little bit about market structure and sectors, very little on stock picking. I do weekly, where I'll spend less time on education of the fundamentals of different indicators or software, but I'll look at a top-down approach and look at various stocks that I might be interested in buying. All these webinars are stored on the site as well. If you download the program and you wonder why it doesn't look like mine, you have to go to the add-ons, and there's two files here, filters and user groups. You need to download and run both of those. You can do them one at a time, sequentially. Start the program, let it update, and then you'll be able to do everything that I do. So without further ado, let's start our top-down review. So the first thing in a top-down analysis is I've got to figure out what the market is doing. I love TradeStation. I've got a number of proprietary things that I've had coded for me based upon what I've learned from the people that I've mentioned, proprietary in the indicator development, not in the concept. I like to look at S&P 500, the Dow, and the NASDAQ. I look at certain things. I look at the color of the bars. This is an elder indicator. Green tells me I can buy or hold, but I can't sell. Sell short, that is. Red, I could sell or hold, but I shouldn't be buying new longs. And blue allows me to do buy, sell, or hold. I look at MACDs. I like the histograms and the MACD lines, looking for divergences. And then a non-elder indicator is the high jump, which basically goes back in this setup. I have it going back looking at 200 days or 200, an interval of 200 bars, and seeing how the distance that adds up the closing price to the 17, the closing price to the 50, and closing price to the 200 daily moving averages, you add those up and plot them. And I know that when I get to 100% or 95, I have a high risk of a pullback. So the S&P 500 is green. That's bullish. It's at the top of the upper envelope. I know that often it rides up the upper envelope, so in itself that's not a sell sign. I am concerned that I'm breaking out a new high here and barely a nubbin on the MACD histogram, suggesting this might be a divergence. My high jump is 86. I'm green in all the paint bars, so it's okay to be long, but I need to be aware that that's, especially on that divergence, is concerning for potential for a possible pullback. Take a look at the NASDAQ, which I believe has been leading this market, and if you look at the NASDAQ, you should see it's even above the outer envelope. Everything is green, and it is, as you can see on the weekly, as well as, if it ever writes, come on, as the daily chart above the envelope, everything green. Again, we're making a higher high here, and let me show you what I'm talking about on the we've got a going down there. Whoops, I don't want to do that, do I? No. While we have the market going up. And so there you have a divergence between the MACD histogram. Now, it might be early and it may pick up this week, but that divergence worries me. So everything's green, so it's okay to be long, but I'm a little bit cautious because we're at 100 on the high jump bar and clearly have what looks to me like a MACD divergence setting up. And if I look at the Dow, I'll see similar findings as the S&P 500. Everything is green, not at the 100%, as you'll see in a second on the high jump bar. Come on. %85 or so, green within the envelope, green on weekly and monthly, and again, new highs on price, but not on the MACD histogram. So concern about potential for at least a short-term top. Give you an idea of how exuberant the market is right now. I have a list that I track daily, and I look for findings intra-market. I can scan for green candle lows, red candle highs, ISO failures, breakouts, breakdowns, squeezes. I'm just here, I put it on the viable gap ups. And these are how many viable gap ups. The ones that are yellow didn't meet the criteria. In this case, 2 of them for volume. And here's one that's below the 200-day moving average, so it wouldn't have counted either. I also look at candlestick patterns, MACD divergences, and other things. But the thing that most impresses me here is the number. So you got 60 down to about 90, so 30 viable gap ups out of about 800 stocks. That's huge on the ones that I follow, but it tells you some of the exuberance that we're seeing in the market, and exuberance to me sometimes bring us a top. I look at other products. to help me feel what the market's doing. One is performance. So I use what's called the Group Performance Analysis tool within HGSI. I look at a number of different searches that I've done and put together over the prior week, and I look to see how they perform on a daily basis, and at the end of the week I'm taking a look at weekly performance. And what do we see here? We see that first, take it from me, black is good and red is bad. Most of the groups were up for the week. Now, interestingly, the S&P 500 was up a little bit over 1%, but our stocks did much better. The stocks I looked at last week as potential buys were up 1.84, so 80% above what the S&P did. The IBD 50 was up 2.7%. My holdings were up 2.9, so I was very happy, and the HGS 100 was up 3.9. So growth stocks certainly had a great week. I'll show you how I do the GIF at the end, but of the top 30 by GIF, they were up 3.19%. And that's an easy search that takes 5 minutes and doesn't require all the things that I'm doing here. So the market showing big numbers. You don't get 3% weeks as a routine. That's exuberance. Bucketology, I do this every week. 70% of the stocks trading above the midline on the Bollinger Bands. Bullish, not over bullish. But what is over bullish is the number of stocks that are at the top 2 deciles of the Bollinger Bands or outside. So you have about 40% of the stocks that are at a place where they're considered extended. Now, I've learned over the years things get a lot more extended before they fall, but we're extended, and it wouldn't surprise me, this extension with the high jumps at about 100 on the NASDAQ, that before too long this market's going to pause or pull back. Pause would be great. I look at the Hindenburg. Hindenburg is when the professionals are selling and the individual investors like us are buying. It's important because no great fall in the market has ever happened without being preceded by a series of Hindenburgs. Now, we saw some Hindenburgs in May and early June, and that's when we started our biggest pullback of the last year since the bull started in November. But we're all clear on that right now. So again, I remain concerned that we're topping. As I said, we're getting into nosebleed territory, but I'm not saying that I'm shorting everything on Monday because I'm going to look for the market to tell me what it's going to do and when it's going to do it. I like to then open up HGSI and go into the warehouse view. Something that I mentioned to you before is about downloading the Woodward and Brown groups. I like to go to those Woodward and Brown user groups, open up the Major Markets Plus, switch my view to Top Down, which is a balanced weekly and fundamental. We have under the reference library. So just to explain what I'm saying, actually this is not balanced, this is all technical, it's all price and volume, and I'm looking at, it's balanced over a couple of different weeks. We've got a 13-day EMA, but it's looking at price change, accumulated distribution, and force, which is price and volume. So this is all technical factors. So over the last 2 to 3 weeks, technically where the strength has been stocks, not in volatility. Little stocks, growth stocks, NASDAQ, NYSE, small caps on the top, which is why HGSI stocks and IBD 50 stocks have done so well. Gold, silver has been weak, as has volatility, and gasoline. I like to look, and let's start the S&P 500, and let's spend a few minutes looking at recent past of the S&P 500. Now, I want to erase everything that I've done here and redo it for you because I think there's a good story to be told here. All right, so high of the market, or April 12th, pull back to this red candle low, sort of a hammer. We had a 10.8% pullback starting in April 2012, ending in June, over 43 trading days, which is almost 2 months. Then the market went into a nice run. We had a return to this high bar here of 16% in 72 days. So had you just gone to sleep here and not done anything, the market grew 4% despite a big pullback. This was the high of the market for the year, and subsequently we had a pretty deep pullback in the market, at least in the S&P 500, of this green candle low of about 9%. Since that market low, it's not been a nonstop bull run, but had you done nothing and went to sleep and left your stock in a mimicker of the S&P 500, you've been up 27% in about 7 or 8 months. That is what you call a bull market. It doesn't get much stronger than that, and that's a whole lot to love. Now, it's not been a straight shot. You've had a series of, here is a pullback. You can see here 3.4% in 8 days, 3.2% in 5 days, 3.8 in 5 days, and then the big one, which was a little bit over 7.6% in 22 days, so the month between middle of May and middle of June. So it's not that we've been without pullbacks, but we're clearly at a point now, we've taken out these highs, that one would expect another pullback. The high jump bar, at least here on the S&P 500, is not at the top, but you can see when it gets to that 100% level, you get a signal, the higher you get, of pulling back. And we're getting to a point now where that becomes risky. As I said, and I'll say it again, markets can get a whole lot more extended before they crack. So you've got to trade the market we have, not the market one thinks we have. All right. So that's enough for the S&P 500. Let's just take a look at some of the others. Let's look at the NASDAQ composite. I'm not going to spend much time because they all look the same. Powerful uptrend, all my momentum indicators green, right at the top of the high jump. So you look at his past history. Whenever you get to the top of the high jump, you roll over. Now let me tell you a little secret. If it gets more extended, the high jump pushes up some, this won't be at the top anymore. So it may be that we go a ways before we pull back, but I think we're at high risk of pulling back sooner than later. If I look at the Dow, again, the NASDAQ's the leader here. The Dow is a little bit less extended, not at the top of the high jump, but it too is in a big bull run for, since the lows in late December. If I look at small caps, Russell 2000, similar story as the S&P 500, the NASDAQ, and the Dow, multi-year highs, breaking out to new highs on Friday. Tired perhaps, but I'm not sure. If you look at the NYSE, which is a nice mixture of big, small, and medium, or the S&P 1500, again, powerful up move, deep pullback in June, and now breaking out to new highs. I look at the S&P 1500. I usually spend more time on these, but they all look the same. Looks just like the S&P did, where I did my analysis. Very bullish-looking stock market, except for the fact that it might be too bullish and telling me it's time for a pullback. The VIX. VIX is at a point where it doesn't get a whole lot lower. So a falling VIX is associated with a rising market. A rising VIX is associated with a falling market. So to me, the most bullish market is when the VIX is really high and starts to drop. And the scariest was when the VIX is very low and it can only go up. And we're getting close to that point where the VIX might start to go up, which would not portend great for the market. Now the dollar is also at a place where it might want to bounce, sort of stop here on the 200-day. And this recent success in the market was associated with a lot of weakness in the market. And rising dollars is not always good for the market. but we have had periods of time of late where strong economy, strong dollar, strong market have gone together. You want to know what looks like a bear market, just look at gold or silver. And I sort of blew it here and said I wouldn't touch gold yet. I want to get above the 50. It's stalling at the 50, and if dollar goes up, it's going to continue to have a hard time at the 50. If it breaks through the 50, it might run up to 148, 150. That would be a very nice return, and that would be the natural target if it can stay above that 50-day moving average. Silver is even weaker. It's not even up abutting the 50-day at this time. All right. So market bullish. Obviously, I've said enough concerns about needing a pause to refresh. I like to look at industries and get an idea of what's moving and what's not moving. So there's 146 overall. I look at what's working now. So I want to look at the force indices, so Elder Force Index. I want to look at 2-day EMA up. So these are the ones that are moving right now. So you can see about half of them are going up. A lot of them are going sideways, and you'll see 15 or 20 are going down. Now, I like to look at the top 10 groups and see within these top 10 groups, are there any attractive stocks? I want to go quickly. Internet retail, so we're going to eliminate the first one. It's a calculated thing, not based upon individual sectors. Changed index group on internet retail. I don't know what to say about these guys. Yelp, I don't know how they, 2 Bible gap ups in a row, everything is green. Let's drop my earnings thing down, not that they make any earnings. No earnings, growing revenue, probably, I use them for figuring out where to go and what other people think. It's a great story. Kahunas, tons of volume. Momentum story, you hang on to these and hope you're not putting KY jelly on your hands when you're grabbing onto the pole, or else you're going to slide right down. These are momentum plays. I don't like to play momentum plays because unless I got in early like I have with VIPS, I don't want to be the last one buying. LinkedIn, or excuse me, Facebook rather, changed its colors. Could have been a buy the day before as it broke above the 200 on Kahuna's pocket pivots, but I wouldn't have picked that up to end of day, and it gapped up with earnings. It's changed its tune. It's back up to the IPO price. Listening to all the jibber jabber on the airwaves and looking at some of the analyst reports, Facebook probably runs up from here and starts to participate in the internet fund. Yoku.com, another one of these momentum plays, Chinese broadcasting television play. Couple of Bible gap ups, everything is green, doesn't make money. You buy these at your own risk. Multiple Kahunas, huge volume coming in before the Bible gap ups could have given you a hint if you were looking at it to get in. Price lines there, but in essence of time. Automobile manufacturers talk about momentum plays. You've got Tesla. Again, when these stop, no one knows. You just don't want to be the last one getting on. Doesn't make money. Lots of good hype and story. Great car. A lot of targets for 200 on the street. As long as the market goes strong, you might see this thing behave nicely. I'd rather get into stocks that are more predictable to me. Ford Motor Company has had a great pattern up as far as I'm concerned. Making money, everything is green. A couple of Kahunas popping out here on Friday. Winnebago, it's hard to believe. Actually interesting to me as well. Give me a little bit of base Kahuna on Friday, all green, makes money. Now, frankly, we've been talking about Winnebago for 2 or 3 weeks, so this is something that's already run since we introduced it off of the 50 a few weeks ago. Third group down is probably going to be biotech. Let's see. Internet software, can we say LinkedIn, Baidu, Mercado Libre, Google? I mean, this is where the money is flowing. These are the rah-rah momentum plays. LinkedIn actually is increasing earnings estimates, a couple of Kahunas. Gapped up with the Bible gap up on Friday with earnings, very exciting. Baidu, Chinese Google, it too is running. It was in a very long-term downtrend. It has changed. It's now above the 50 and moving up, and probably one you want to pay attention to. Earnings growth not so great right now. Maybe it will pick up. Mercado Libre does have earnings per share growth. This is the South American eBay. Nice gradual pullback. Scooped double bottom perhaps here. running again with a number of pocket pivots and a Bible gap up on Friday. And then which one gets first to 1,000, Google or Priceline? I guess I'll put my money on Google. But a very nice looking chart, lower left, upper right. Not spending much time on things you already know. Biochem, I'll give you some thoughts on this one. Biogen IDEC, we talked about a few weeks ago as it pulled back to its 50 moving average, and it finally popped off with a kahuna on Friday, one to look at in a very strong group. It had a huge run before it pulled back and went sideways for a while. BioCryst is a small company, had some positive data. Here's your little type flag, running again. Probably too late to get into this one. You had some kahunas in here. You had some huge volume as it was breaking above the squeeze area here, and then it just was off to the races and too late. Pharmacyclics we've talked about many times. They've got a new drug for chronic leukemia, most common in adults. It's got a market cap now about $8.5 billion, so it's no longer cheap, but it will continue to run up into probably later this year when it gets approved. My guess it gets approved end of November, beginning of December at the big hematology meetings. They're going to have to turn from a development to a commercial entity. And if you look at a lot of the recent drug approvals, Medivation included, they run up. Another one would be Ariad. They run up until approval, then they pull back with the cost of commercialization. This one both has that in place, so I expect it to run potential takeout by Johnson & Johnson, who has a partnership with them. Insight had some good data come out this week, and you could see a company that's been going sideways since March, had a kahuna on Thursday and took off again on Friday. They got a lot of neat things, pipeline in their current product. Mankind is one I talked about last week. I talked about how I liked the pattern when it was going sideways until the moving averages caught up, and it took off again on Friday, waiting for a drug approval potentially on their diabetes drug, and approval takes this thing to 20, it's been as high as 24 in the past. I think there's high risk. It's been turned down twice, but the turn down has not been on whether or not the drug works. It's been on whether or not the production and the variability from lot to lot. So certainly is a possibility there that you might see this stock run, but again, not without risk. A lot of nice things in biotech. Celldex is another one that I like in the oncology space, preclinical, going sideways. Had a kahuna come in Friday. Everything is green. You're buying based upon promise, not about earnings. It's had a rather orderly run up. I think it wants to run again. I guess it's a third stage base. So first stage base, second stage base, third stage base breakout opportunity on Celldex. The leaders by far, GILD, had a big run-up, starting to consolidate a little bit. Gilead. People wonder why I'm so high on Gilead when it doesn't look like they have a whole lot of earnings play. They own the HIV market. They will own the hepatitis C market, and now they're getting into the oncology market. And if I just step out a little bit and let me just look at MarketSmith and look at Gilead earnings. Gilead, after an earnings slowdown this year, is going to be going into an accelerated earnings period of time. And this is what's getting me excited. Multiple of 30, growing 52 times into 2014. Here's your cup. Its handle. It's going to run again, and I think Gilead is worth putting money. In fact, my big position that many people know is Celgene. I've been very bullish on this since it pulled back into the 40s or 50s. I've actually half my position, and it's a big position. I've got 150 calls on, and if I get stopped away, I'm just going to take the cash, keep my half position that I have left, and then buy more Gilead, because I think Gilead will be what Celgene has been. And you could see after long bases that this stock likes to run, and it's run again. It's overextended. You can see how it's at the top of its high jump bar. And one clear, the reason why I wrote the calls is I've expected the stock to pull back, and we shall see. Great stock, love it. Great company, love it. Sometimes you just got to take a break. Healthcare equipment, don't know anything about this group except Stereotaxis had a technology approved. When you look at the chart, you got to believe that no one thought that was going to happen. Again, don't know anything specifically, but how often do you see a stock lingering around at less than $2 and it ran all the way up to $6 in a single day up to $7? Long-term holders for that stock certainly got rewarded. Now, if I go on a monthly chart, and I haven't done this, so I don't know the answer, the stock was, well, there's probably been a lot of splits to get it to $154, reverse splits. But it once was a pretty high flyer, and it's been a pretty low rider. I'd look into this and try to understand it better, but something's going on here. Flagpole, your flag, taken off again. Might be interesting to see if there's still play here. Don't know Mako Surgical. It too was hammered down below the 200 for quite some time. Looks like it's taken off again here. Big volume on Friday. Don't know if that's in sympathy with the last one. Boston Scientific has really been a nice uptrend, but still a cheap stock, but it's doubled since January. All green. Don't know much about what's new with them, but the pattern's very pretty, although certainly getting extended. You see the high jump bar. All right, next group down. This is what top-down investing is, one group at a time. Oil glass exploration, we talked a lot about last time. I told you about my cabot trade. Puts are gone. I've made money on the calls, and now we'll see what happens. There's a lot to like in this list. I don't know how to limit it to one or two. Let's look at the top couple, then I'll point out a couple that I'm sort of fans of. This group is on fire. You can see all the greens on the A and B accumulation distribution. Here's Pioneer Natural Resources. Big takeoff last week. We had talked about this one on the review last week. Pocket pivots on Wednesday, then a Bible gap up on Thursday. Gas is going up. Oil is $100 plus a barrel. These guys, if they are meeting their production targets, they're all going to beat their numbers. Even Chesapeake, which has been a storage stock with a storage CEO, looks like it's running again with a bunch of pocket pivots, a kahuna on Thursday, and a Bible gap up on Thursday. Looks very impressive. I talked about Continental, one of my favorites. Said it wants to get above 100. It got to 99 on Friday. It has a tendency to get up to 100. Again, I don't know how to limit these. So many of them are good with good charts. Let me point out a couple that I thought were extra interesting. Oasis, we've talked about before, great earnings growth. In a stock that's taken off, it's a little cheaper than the others. Had a couple of kahunas on Wednesday and Thursday last week. I think the stock wants to run. If I look at Oasis here, OAS, you'll see that it has nice earnings per share growth going in the next couple of years, different than some of the others, more than its PE. I like to see that. The other one that I like is EPL. Look at the earnings per share growth coming in 13, trades at a multiple of 12. If that drops to 10 on a PE of 42, the stock gets up to $42, which is 20% from here. And then I mentioned Cabot Oil and Gas is another one with great earnings to play, earnings story, but a much higher multiple last time. Computer hardware, not going to spend much time here. I'll talk about two stocks. Dell is all about M&A and buyouts and dividends. I can't watch that. But Apple, a lot of people think it's changed its stripes and it's running again, putting in a double bottom around $395 rather. And I'd like to see it get above the 200 and stay there. If it does, I might be interested in starting to play Apple again. Until it does that, I've been out of it. I've missed a run. I recognize that. I found some much less riskier plays, and I've had several weeks of 3% return, so I'm not going to complain about that. But it's in the process of a very nice return, a nice run. Pharmaceuticals, sort of different than the biotechs, and I'll use J&J as and Pfizer as the standard bearers. Lower left, upper right, tight move, as you'll see. So what's different? No growth and a huge dividend, 2.8% on this one. If I look at Pfizer, you'll see another chart. This one had pulled back They had some restructuring last week, which caused it to pop up here. 3.3% dividend. Abbott's another one that had pulled back that has a nice, or actually Lilly had pulled back, and it too has a dividend of 3.6%. And I thought it was a safe place to buy last week. Coming off the 200, you have a little bit of return, and you're holding it for a nice dividend. Those aren't the stocks that I love. I'd rather be looking at something like Valiant and Santoris. Let me look at those. Here's Valiant. Valiant's a very tight lower left, upper right Canadian company, grows by acquisition, and then cutting sales teams and reducing costs of operations. They just bought Bausch & Lomb. There's some little hullabaloo in New York where they're closing one of their big offices and some jobs will get hurt. Bad for jobs, good for the stock, lower left, upper right. Looks to me like it wants to run again. It's been a great performer for me. Another one that I've talked about a lot that somebody was concerned about was Santoris. There's a nice shallow pullback on a stock that makes money. I think it's just setting up to run again. Everything is green. I don't see anything to be concerned about. I've been in this one for a while. SNTS. Great growth. Big PE, but smaller than the growth rate. I still think this stock can see 50, 45, or 50. Potentially as a takeout candidate by somebody who needs to buy some earnings. High rankers in this group, we'll look at Questcor. This is one that you have to have an iron stomach for. When you look at this chart, at least if you don't look at the left-hand side, it's a beautiful stock. Took off with some recent news, some expansion of their portfolio. The shorts love to kill this stock, and it's been hammered by newsletters and things in the past, and I'm always nervous by it. But it's been a huge move. We talked about it last week, and I believe the week before. Number 10, or really number 9, because there was an index there, the banks. Banks are usually at the top one way or the other based upon their volume. I'm holding Bank of America. Look at this as indicative of the banks, and you could see a nice tight lower left. Here's your tight, no, not tight, medium, lower left, upper right, at its highs, all green. The nice thing about banks is that they probably will do okay with rising interest rates. Now, I've been into some regional banks, T being one of them, certainly looks a lot like that chart. Almost exactly breaking out to new highs, and PNC. There's been a lot of money to be made in the regional banks, which both Ron and I picked them up at the same time with our little bit different approaches. The 10th group then of today is broadcasting. These have been strong for quite some time. And I'm going to point out EVC is one that I was interested in. It's a cheap one that had pulled back, had a huge day on Friday, and I'll take a look on its earnings. You can see it's a cheap stock, pulled back, got above the 50, had a kahuna DI change, nowhere close to the upper end. And I like to look at this and look at its earnings growth and its fundamentals a little bit. And the only fundamentals I care about are earnings, frankly. Multiple 25, growing multiples of that. 25 times 50 is a $12 stock. I'm not saying that it's going to, if it drops to 20, it's a $10 stock. It's trading at $6.52. This has been a great group for many of us. I made money on Nexstar and Sinclair, and I wonder if Sinclair isn't giving me signals that I might want to be into it again. It's struggling to get above the 50, but if it does, and I take a look at Sinclair, you can see $2.62 and a lot of earnings growth coming. Stubbed its toes on earnings growth for 2013, and that probably explains the stock's pullback of late, but certainly a leader. And off that 50-day moving average is not a bad time for me to be nibbling and buying a stock. That's the top 10 groups. I got to look at the 11th because is it time to get back in home building? I don't know. The strongest one of the charts to me looks like Ryland. It's hammering now or trading between the 50-day and the 200-day moving average. It never dropped much below the 200, which is different than some of the others. A couple of kahunas came in this week. It's got great earnings per share growth. If you want to be in home builders, you might want to nibble there. The top two ranked ones, Pulte and Toll, both deeper pullbacks below the 200 here on Pulte, although it looks like it's going to start playing some ping pong and try and get above these moving averages. And Toll Brothers also struggling to get back above the 200. I'm going to make sure my son got in. Let's continue on as we run into the finish here. So as I said, housing, I don't know, it's got up there on the list pretty good. Ryland looks okay. I need some more proof, although perhaps they are putting in a bottom. You know, interest rates, maybe they're going to stop going up because the Fed's going to keep QE going on, in which case we'll see another leg up. As I mentioned, there were not a whole lot of groups that were force indexed down. Let's take a quick look at some of those. Semiconductors. I guess this will tell us what a bad group looks like or a bad stock. Big pullback and bounce off the 200-day moving average we'll see for on semiconductor. So the weak ones were semiconductors, big industrial conglomerates, oil and gas storage, apparel and retail. You know, it's funny. One of my favorite stocks right now is the Gap. And I've been in the Gap since it pulled back, sort of a double bottom off the, I'll show you right now. This has been my favorite apparel stock. Right here, the squeeze, breaking above with kahunas and a nice run since then. Probably getting a little bit long in the tooth. So just wanted to show you that there were not a lot of groups that were down, and these were the groups that were weak. All right, so that's how I do top-down investing. I accumulate a list of stocks from these top 10 groups or so, and then I'll see how they do when the market opens on Monday, realizing that I don't buy stocks just because they get on that list. I've got to see something happening, the right price and volume action during the week. Now, a lot of people, complain is not the right word, but they argue that they don't have enough time to do the analysis that I do, and they want me to show them a couple shortcuts. So, shortcut number one, all securities. Then go into miscellaneous, Sprinter, and here you got one search, one view, 109 stocks. You notice it's all green. These are all technically and fundamentally strong stocks, and you're going to find some really big winners here if you look at them. LinkedIn, Goodyear Tire, Yelp, Facebook, Valiant is here, Questcor is here, Biogen IDEX is here, Insight is here. So it's a very simple step where the best of the best come to the top. I like to always end on a GIF, and I've already done it, but I'm going to show you how I do it. Tools, Group Inclusion Report, clear everything, and I want to go into Smart Groups. Where else in Catcher, I want to look at stocks that had a Bible gap up, had a pocket pivot, and the assumption here, if the stocks are in strong groups, the ones that are in the most of the strong groups are the best stocks. I like best criteria, I like Berg 240, I like growth, HGS 100 leaders. Quarterly preps, stocks and groups to the upside, and strong EPS. We're going to call that 1111 Web Gems 8.4. I only want the top 10 or so. Hit OK. Do I want an index? No. So here's the stocks that made it to the top of the lists. Now these are not top down, these are bottoms up, looking at the best stocks. So I look at a combination. This is a great way, plus the sprinters, of finding the best stocks irrelevant of the groups. And then if I open up my warehouse, I can find the group we just put together, the user group, and make sure I've got my top down here. Scorecard no index. And let's just take a quick look at these 10, and then I'm going to say goodbye. I'll show you my buy list and I'll say goodbye. LinkedIn we already looked at, certainly a leader in this market. Lithia Motors, LAD. This is one of the auto dealers. If cars are strong, you got to buy them somewhere. This one and Asbury have been very strong. FleetCor is sort of a hybrid credit card, refinery, marketing, service station company for trucks and long haulers. We've talked about it a zillion times. Gave us a great buying opportunity off the 50, starting to run again, makes it to the list. Webcom has been a high earnings growth and now growing stock, web-based IT consultants helping with websites. Smith & Wesson, make my day. If you want to buy gun stocks, both this and RGR are very strong. Acadia Healthcare, they own skilled nursing homes, and sideways to a bunch of pocket pivots. All Mrs. Bible Gap, everything is turning green, earnings coming into this stock. It's a very bullish pattern. I probably want to find out more what's going on with it. Asbury Automotive, like LAD Lithia, is an auto dealer. NIC, management consultant. Problem is you're going to say it's too late, and you're right. This is when we should have bought it. Stock had pulled back to the 17-day and had a kahuna, everything green up there, and it's gone now. Boom, Bible Gap up. Now, you may still want to buy it because Bible Gap ups, they have a tendency to continuing to run. Yandex, Russian internet provider, certainly a leader. Multimedia games, I own MPL and LDS, but another in the casino world. You like to buy these things on pullbacks. It's certainly extended, but in a nice run. So that was a different test to find the strength in the market. I typically look at the top 30 when I do this by myself. I'm not going to go through all these right now. But if you look at these, a lot of stocks we've already seen: EPL, Facebook, FleetCor, LinkedIn, Lithia, Mercado Libre, ON Financial broke out this week. A lot of the stocks we like to look at will fall into that list. Lastly, I told you I'd let you see my buy list. I'll do it in two formats. We'll do it the broad-based format, and if there's anything to comment on. This, I'm not telling people to go buy Unipixel. It is a bottom fishing disaster du jour, and here's why I put it there. I'll come back if you didn't take your screenshot. Pullback, putting in a bottom, kahuna, pocket pivot, volume came in Friday. This is a high-risk, dangerous stock to own, and the only reason why I'm even looking at it is it was a high flyer, got killed by the shorts, and it hasn't taken out that 338 earnings projection for next year. It's worth a whole lot more than 15 bucks if it gets anywhere close to $1 or $2 in earnings. So who knows? It's not a growth stock. It's dangerous. I like to have a few speculative plays. Mankind is my other big speculative play that I'm holding right now. Home Depot is right at its 50-day moving average. Gilead I talked about. A lot of my favorite stocks are there. And then lastly, what I like to do is I like to categorize those buy stocks. So I have based as Bible Gap ups. These are super extended stocks that may not make any sense to buy based upon the fundamentals, but Bible Gap ups do well. LinkedIn and Yelp, we looked at both of them. Breakout EPS All-Stars, I showed you Oasis. Shame on everybody didn't buy Axle or Federal Mogul. Axle is one of these automobile suppliers that I said are major turnaround plays. They fixed some of their union and their retiree benefit problems, and they've got huge earnings coming in. All right, the stock traded last week at about $17, $18. It broke out on Friday. If you take the multiple down to 10, or say 20 rather, $1.77 is $35. It's trading at 21. 20 times 278 is 56. If somebody doesn't buy this company, which I think is probably the most likely, $1.5 billion market cap, and it makes so much money. Why would you not want to own this stock? I don't understand. I like growth stocks. I like stocks that make money. I like stocks in uptrends. I like stocks that secular market changes are going to help. The auto industry is certainly on fire. The next derivative is either where you sell them or where you buy the parts from. Here's American Axle, and you could see multiple kahunas the last couple of days after going sideways, pocket pivot on Thursday, gap up on Friday, DI crossover. I think this one's going to go much higher. So leaders extended are gone. These are these here. Pullback ready to run are stocks that have been in an uptrend and have pulled back to major support, and I look for them to move. They've had a kahuna come in or a pocket pivot, something that says they're moving again. Pullback waiting for signal are stocks that have pulled back to a major area, and I'm just waiting for that signal to come in and tell me to buy them. In the case of Ryland, it's about getting above its 50-day moving average. It's in that squeeze from the 50 and the 200. In Santoris, it's showing me a pocket pivot or a kahuna that it's breaking out of that little scoop pattern that it's in. And Unipixel is a bottom fish. So I hope you guys get value out of these. I enjoy doing them, and I'll continue to do them as long as I feel people are finding them useful. Once again, my name is Jeff Scott. Here's my email address. Have a safe, have a profitable week. And sometimes, I've learned this years ago. Now, I'm not that old, but I'm old enough to know better, that when things start to get too easy and we start to think that things are different this time, they never are, and never are different. 3%, 4% returns are not normal returns. And we've seen 3 out of 4 weeks when my stocks and the HGSI and IBD index leaders have done 3% returns. Those are not normal. Those are more evidence of an extended market. Don't get hurt. Protect your profits. Don't get out of the market until the market tells you to get out, but don't be silly. On that note, everybody, goodbye, and we'll see you next week. Bye-bye.